Welcome to Skilled MBA's case study on Arsenal Capital Partners' refinancing of Pinnacle. In this session, we will examine how Arsenal Capital Partners, a leading private equity firm, strategically refinanced Pinnacle, a high-performance adhesive technologies company. Pinnacle experienced exceptional growth, increasing its EBITDA from $13.5 million to $60 million in just 2 years, a 344% increase. With this rapid expansion, Arsenal faced a critical financial challenge: securing the right capital structure to support future growth, fund acquisitions, and align with an optimal exit strategy. Through this case study, we will explore the financial decisions, macroeconomic pressures, refinancing options, and final recommendations that shaped Pinnacle's future. To understand the need for refinancing, let's examine Pinnacle's incredible growth journey under Arsenal Capital Partners. At the beginning of Arsenal's investment, Pinnacle had an EBITDA of $13.5 million. Over just 2 years, this number skyrocketed to $60 million, reflecting a 344% growth rate. This remarkable performance was driven by strategic acquisitions expanding Pinnacle's product offerings, operational improvements enhancing efficiency and profitability, market expansion into high-growth adhesive technology sectors. However, with rapid growth comes new financial challenges. Pinnacle needed a refinancing strategy that would ensure long-term sustainability and continued expansion. Pinnacle's refinancing was driven by 3 major financial objectives. 1. Support future growth. The company required sufficient capital to fund operations, research, and market expansion. 2. Fund upcoming acquisitions. As Pinnacle looked to acquire more companies, it needed a strong financial base to facilitate these deals. 3. Plan exit. Timeline. Arsenal Capital had to structure financing in a way that aligned with potential exit strategies, ensuring a high return on investment when the time came to sell Pinnacle. These financial goals had to be balanced against macroeconomic pressures, including COVID-19 disruptions, rising inflation, raw material shortages, and market uncertainty. The refinancing decision was also influenced by external economic conditions, including COVID-19 disruptions, supply chain bottlenecks, and operational slowdowns. Rising inflation, increased material and operational costs, raw material shortages, limited availability of critical production components, market uncertainty, fluctuating interest rates affecting borrowing conditions. Navigating these economic factors was crucial to ensuring a robust and resilient refinancing structure. The refinancing decision involved multiple stakeholders, each with distinct priorities. Arsenal Capital Partners, the private equity sponsor responsible for maximizing investment returns. Pinnacle Management, the leadership team tasked with implementing financial and operational strategies. Various lenders, banks and financial institutions evaluating different financing options. Acquisition targets, companies. Pinnacle intended to acquire as part of its expansion plan. Understanding each stakeholder's perspective was vital in structuring an optimal refinancing approach. Arsenal conducted a SWOT analysis to assess Pinnacle's financial standing. Strengths: rapid EBITDA growth, strong market position, and operational efficiency. Weaknesses: high capital requirements, supply chain vulnerabilities, and integration challenges. Opportunities: further acquisitions, capital structure optimization, and expanding into new markets. Threats: economic uncertainty, inflationary pressures, and potential financial instability. These insights guided Arsenal's refinancing strategy to maximize strengths while mitigating risks. Arsenal considered 4 different refinancing approaches, each with its own advantages and risks. Option 1. Expand current direct lending. Quick execution with existing lenders. Simplified management due to fewer financial partners. Limited scalability and reduced flexibility if market conditions changed. Option 2. Hybrid lending approach. Diversified sources, blending existing lenders with new partners. Moderate flexibility, balancing stability and risk. More complex lender relationships, requiring careful coordination. Option 3. First lien syndicated loan. Lower borrowing costs and access to a larger capital pool. Stricter compliance requirements and reduced financial flexibility. Option 4. Comprehensive refinancing combines first lien and second lien debt to maximize funding. Highest flexibility, but increased complexity and cost. Each option had trade-offs in cost, flexibility, risk, and growth support, requiring a careful evaluation. To determine the best refinancing option, Arsenal used 4 key evaluation criteria. 1. Cost efficiency. What are the interest rates, fees, and overall financing expenses? 2. Operational flexibility. How adaptable is the financing structure to changing business needs? 3. Risk management. Does the financing structure mitigate financial risks effectively? 4. Growth support. Does the capital structure provide sufficient funding for future acquisitions and expansion? These criteria helped Arsenal weigh the long-term impact of each refinancing option. In today's financial landscape, choosing the right funding strategy is critical. Let's explore a comparative analysis of different financing options. Direct lending offers moderate costs and low risk, but flexibility and growth potential remain limited. A hybrid approach balances cost and risk while providing moderate flexibility and growth support. Syndicated loans come with lower costs and higher growth potential, though they carry some medium-level risks. Finally, a comprehensive financing strategy provides maximum growth opportunities but requires higher costs and a higher risk tolerance. When selecting a refinancing option, several key considerations come into play. First, acquisition strategy. How will refinancing support planned company purchases? Second, risk tolerance. What level of financial risk is acceptable? Third, exit planning. Which option aligns best with the investment's exit timeline? And finally, economic outlook. How will macroeconomic factors influence the chosen strategy? This case study provides several key takeaways. 1. Balance is critical. Effective refinancing requires balancing cost, risk, and flexibility. 2. Monitor economic indicators. Staying aware of inflation, interest rates, and supply chain disruptions is crucial for financial decision-making. 3. Align with growth goals. Financing structures should support both short-term needs and long-term objectives. 4. Prepare for uncertainty. Companies must build financial adaptability to navigate market disruptions and economic downturns. By applying these lessons, companies can develop robust refinancing strategies that drive sustainable growth. After evaluating all financing options, Arsenal chose a comprehensive refinancing approach that combined first lien and second lien debt. Why this strategy? Maximized capital availability for future acquisitions, balanced flexibility and risk, ensuring long-term stability, optimized cost efficiency while providing the financial resources Pinnacle needed for expansion. Implementation plan. Secure first lien and second lien financing agreements with favorable terms. Closely monitor financial markets to adjust as needed. Align capital structure with exit strategy to ensure maximum investor returns. This approach positioned Pinnacle for sustained growth and a successful investment exit for Arsenal Capital Partners. In conclusion, Arsenal Capital Partners successfully refinanced Pinnacle by implementing a comprehensive capital structure that supported growth, acquisitions, and investor returns. This case demonstrates the importance of strategic refinancing decisions in private equity investments. Thank you for attending this skilled MBA case study session. We now welcome your questions and discussions.